Welcome back again, YouTube. This is Nick the Kid here with another video. So if you like the video, please hit that like button, hit the subscribe button down below. So in this video, just want to cover some retirement slash investing tips and ideas. So right now, this is coming up on late September of 2022 right now as I'm filming this. And right now, during this time of the stock market and all the indexes right now have been absolutely devastated this year. We're in a pretty rough bear market right now that we're going through. And a lot of people are speculating that we're going to be going into a long-term recession here coming shortly. And just want to give you guys some just tips and advice. At least this is just from my perspective. By any means, this is not financial advice, so just take it as it is, and everybody do their own research and take their own perspective for what they have. So right now, with the markets being down, I myself, I'm fairly young, so I am going to be continuously buying in these low market conditions right now. I'm a long-term investor. I always think out in the long run, not the short term. And when I initially first started investing when I was younger, I'm 35 right now. I really started investing, I'd say, right when I was like 21, 22-ish, started investing. So I've been investing for a little while now, and especially when I was younger, I just always had this mentality of like chasing the market and moving my accounts up and down and stuff whenever the market was, market headlines were making news and stuff and trying to scare everybody out. I was always one of those that followed suit with the rest of the investing world, and it never really worked out for me in the long run. I always lost money in the long run, and I just never had any real consistency with my returns when I was younger until maybe probably 5 years ago, 5, 6 years ago now, or maybe more than that, probably maybe 7 or 8 years ago now when I started my main job that I have. I just stuck to my strategy and I stayed aggressive no matter what the markets were doing. And currently, right now, this condition of markets that we're in is something that we haven't seen for over 40 years, which just really blows my mind. And but a lot of this too, I mean, okay, maybe not 40 years, but some of the statistics that are going on right now, like with inflation, as an example, that we haven't seen any of that heavy devastation like that since the late 70s and stuff. So, but a lot of people are thinking right around the corner. They're thinking, could this be another 08, 09 crash? And to be honest, if it happens to be that way, that honestly, it does not faze me, not a single bit. I am continuously still being aggressive, putting money away in my 401k, putting money away in my brokerage account, all of my bank accounts and stuff. I'm still putting money away, still making sure that we have savings and paying the bills on time and just moving on with life and continue to keep doing what we've always been doing. And no matter what the markets are, I'm always going to be investing. And I think you should too. I think you should set aside the negativity that you hear in the market, in the news and such. And as long as you're young, obviously if you're nearing retirement or closer to retirement, obviously you want to consolidate and be more conservative with your investment approach. But if you're in your younger towards mid-grade of your career, You just need to keep hustling, keep working, keep grinding, and put that money to work. Because every dollar that you put in is going to be more money down the road that you have for your retirement that's going to make you happy retiree, and you know your plan. You have an action plan for it now, and you have a new action plan for your future when you do retire. So when you're younger, yeah, you want to be heavily invested, you want to be aggressive. When you're mid-career, yeah, you maybe make some changes here and there, but it should be fairly subtle. Shouldn't be, an abrupt change. And then as you get closer to retirement, then you need to be aware of the market situations, what you kind of think the broad markets are going to be doing for the near future, because everything that you have is now you're going to start in retirement, start pulling from those accounts. So you really need to know tax purposes, what goes what where, and all of that stuff. So you all need to do that research. But as far as putting money away, just keep living your life, keep plugging away at it, keep putting money aside, and you will be more than shocked. And I just recently did some research and it blew my mind, but a lot of people say that the market's returns out of a recession, usually in the first year, are like 25 plus, maybe even somewhere in the upwards of 30+% returns. Coming out of a recession, and that just blows my mind. I mean, just like crazy. And then the next several years after are very pretty well off with the numbers. And so that just goes to speak that if you do your homework and you put money away, down the road, it's going to be very, very explosive for you. As long as you continue to stay invested and you don't move your money around. And especially, don't ever stop your investment. So many people that I know have completely stopped investing, or they move all of their money into a extremely conservative fund that has this much growth, so like little to nothing, and that is going to hurt you major in the long run. And then people have the argument of, oh, well, I'm saving money because it's not going up nor is it going down. Well, in the long term, you're actually losing hundreds of thousands of dollars, if not more, for your retirement years because you didn't ride the storm. You have to ride the storm. You have to ride the volatility. And in my viewpoint, as the market continues to drop, there's this thing that's called dollar cost averaging. So as the market is declining, every single week or bi-weekly or whatever your paycheck is, and you're putting money in, and that market just keeps dropping and dropping and dropping and dropping. Yes, you're still putting the same dollar amount in, but that as the markets go down, you're actually buying up more and more and more and more shares with the same cost that you're putting in, the same amount that you're putting in. So that is key, because then when the market starts to make a V-shaped recovery, or maybe not a V-shaped recovery, but just a rebound nonetheless, all of those additional shares that you purchased are going to compound on themselves when the market starts to go the opposite way and starts coming back up again. And so on and so forth. For every single cyclical downturn of a bear market that we have, it's still the same approach. And then the other major benefit too is, as your career progresses and you grow more of your income, you have more money that you can again flood into the markets and continuously invest more year after year after year, where every single time that you get a raise with your job, I always have the insight and the know-how to set aside 1% extra Every time I get a raise, you bump up your contribution to 1%. Every time it's 1%, 1%, 1%. Then you'll get to that number that you want like that. Very, very easy. It's automatic, and you won't even know that it's missing. So those are just some ideas that I think will work in the long run. Yeah, I don't know how long this recession is going to last. It could be 8 months, 10 months, 12 months, 16 months. I don't know. Maybe we're going to have a, rally like we normally do in, mid to late November into December. They call it the Santa Claus rally. Who knows? We might. Maybe it'll lead us into a good 3.5 year bull market for the next, foreseeable future. I don't have a crystal ball, and neither does anyone else in this world. So ride the storm, ride the market, keep investing, stay tuned with what the world is doing, be knowledgeable of those things, be aware of what's going on around you. That way you can make smart investment choices. And if there's opportunities like there are right now, I honestly feel that if we even drop lower, even let's say we go into a recession like we were in 08, 09, that is where the money makers are born. That's where your wealth can totally be a major game changer and extrapolate your wealth for your future. If you only stay put, you stay in tune with your investment strategy, but you make sound decisions for what's going to work for you, your life, and your future, that's on you. Do your homework, do your research, make sure to hit the like button. Let me know in the comments down below what your strategies are, what you have going. And to be honest, I have a government account. It's called the Thrift Savings Plan. And so many people are telling me, oh, you're too aggressive, too aggressive. This is the way I like it. 90% C fund, 10% S fund. The C fund is the S&P 500, and the S fund is the Dow Jones Industrial Average. So that's what I invest into. I'm aggressive with it, and I keep plugging away week after week after week, month after month, year after year. Hope you enjoyed the video. Hit that like button, hit the subscribe button down below, share with the family, share with friends. Keep motivated, keep investing, and happy investing, everybody. Thanks for watching.